Which business structure is the most advantageous to real estate investors and offers the most tax savings? Now, this is the most commonly asked questions that I hear real estate investors ask. And today in this video, I'm going to talk about the 4 different business structures that you can register for your real estate business. And then I'll talk about the pros and the cons of each of those so you can have better insight on which is going to be the best structure for you and that's going to offer you the most tax savings. By the way, if you are new to watching any of my content, my name is Nikki Burns, and I help real estate investors to build 6 to 7 figure businesses and pay the least amount in taxes so they can buy more real estate and expand their investment portfolio. So let's get started. So the first business structure I want to talk about is the sole proprietor. Now, this structure is the easiest and most simplest business structure to form. There aren't any formalities or any registrations required, meaning that you don't have to register with the Secretary of State. You don't even have to register to get an EIN because you can use your personal name as your business name, and you can also use your Social Security number as your EIN, as a substitute for your EIN. Or if you want, you can register a DBA, which is a doing business as, if you choose not to use your name, which means you would just register a fictitious name with your Secretary of State. Now, the cons, on the other hand, are there's no personal liability protection, meaning if your business were to get sued by your creditors can come after your personal assets. Another disadvantage is you have to pay taxes on your entire profits that you generate for your business. So you have to pay your self-employment tax and your income tax, all on your personal tax return. Now, the second business structure is a partnership. Now, there are 2 types of partnerships you can form. You can form either a general partnership or you can form a limited liability partnership. Now, I'm going to explain the difference between those 2. So the general partnership, both partners are dividing the income and expenses and the losses that are incurred in the business on their personal tax returns. It's just based on their ownership percentage in the business. So if it's a 50-50 partnership, then both partners are going to split the income, the losses, and other expenses 50-50. Now, the partnership doesn't necessarily have to be equal, because one partner can own a higher percentage than the other partner. And that is determined based on the agreement that you have with your partner. And all of that should be in your operating agreement. Another benefit of a partnership is the increased skill set and support of the other partner. So let's say one partner is great with, operating the business. They're great at the marketing aspect, marketing your properties out there that you're buying as an investment property and getting either tenants in those properties or just selling them to other investors or home buyers. And maybe you're good at the financing part. Maybe you are investing all of the capital for the company. So having partnership is lucrative because one person may have a skill that the other person lacks. So you put the 2 together and it can help your business grow and you can learn a lot from the other partner. Now, with the limited partnership, offers liability protection. If your business were to get sued, the creditors cannot come after the partner's assets. Now, the disadvantages to having a general partnership is that it's the same as a sole proprietor. It does not offer that personal liability protection. And again, for both the general partnership and the limited partnership, all of the income and losses and expenses are split amongst the different business owners, and it's based on their percentage ownership in the organization. And another disadvantage for both of the partnerships are that there could be a lot of conflicts and disagreements between the partners. So it can kind of make the working relationship difficult with both of your partners if one is disagreeing with the other about another thing, and then you can't come to an agreement with that. Now, moving on to the third business structure, and that is a limited liability company. Now, the advantages of a limited liability company means that you have the personal liability protection, meaning that if your business were to get sued, Your creditors cannot come after your personal assets to cover the debts of the business. Also, there are fewer filing requirements. So the only thing that you would have to register for, you would have to get your articles of organization from your Secretary of State, and then you would have to register with the IRS for an EIN, so that way you can show that you're a separate entity from your business. And another advantage of an LLC is you can choose your tax classification. So if you are a single member LLC, if you choose not to be taxed as a C-corp or an S-corp, your default tax classification is going to be sole proprietor. But you will still have that liability protection, so they can't come after your personal assets. Now, on the other hand, the disadvantages of an LLC is you have to pay taxes on all of the income that the business generates, regardless whether or not you pay yourself the full amount of the entire revenue. Let's say, for example, that your business generates $200,000 in that year, but you only decided to pay yourself $100,000. Well, you would think that you would only be taxed on that $100,000 that you've paid yourself, right? Wrong. You have to pay taxes on the full $200,000. I know it sucks though, right? The second disadvantage is if you are commingling your personal funds with your business funds. Let's say that you're using your personal account to pay for a business expense and you don't reimburse yourself. And the IRS look at that, they're going to say you're not separating yourself from your entity. So they're going to assume that you and your business are one. So they're going to assume that you are operating as a sole proprietor, meaning that you won't have that personal liability protection. So you don't want to do that. So it's always best for you to get separate bank accounts, one for your personal account and one for your business account, and use your business account to pay for your business expenses. Now, if there is by chance where you have to use your personal account to pay for a business expense, then have your company reimburse you for that expense. That way you have an audit trail of, hey, this was a business expense. I had to pay out of my personal account, so I'm reimbursing myself from the company to cover that expense. Make sense? All right. Now, the fourth and final business structure is a corporation. Now, you can be taxed as a C-corp or an S-corp. Now, I'm going to explain the difference between the two. So a C-corp, the advantages of being taxed as a C-corp means that you have that personal liability protection as you do in an LLC. You would be considered an employee of your business. So you would put yourself on payroll for your business, and the corporation pays taxes on its own profits. All the other entities, they don't have a particular corporate tax structure. And there aren't any restrictions on how many shareholders that you can have inside of your corporation. Now, the disadvantages of that, on the other hand, is the double taxation. The income that the corporation generates is taxed at the corporate level and the personal income tax level. So let's say that your business generates $200,000 in revenue for the year. And let's say that your business corporate tax rate is 30%. Your business is going to pay 30% of that $200,000. Now, after the profits that are left over, let's say that the corporation decides to give distributions, which we call dividends, to the shareholders. The shareholders that gets those distributions, they have to pay taxes on that. So that money has already been taxed at the corporate level. Now it's going to be taxed at the shareholder level. And another disadvantage is there are so many formalities as far as paperwork goes and a lot of registrations. So the corporation will have to keep up with all of the minutes and the different board meetings that you have. They have to keep up with the bylaws, and some corporations have to fill out annual reports. So moving on to the S corporation. Now, the S corporation has the same benefits as a limited liability company, an LLC. And with an S corporation, you have to pay yourself a reasonable salary. Now, one rule that I want to, address here, and one thing that you should never ever do is try to pay yourself a low amount of salary and then take the rest in distributions. And another benefit with an S corp is there isn't any double taxation. So you're not going to be taxed at the corporate level and then being taxed at the shareholder level either. And another advantage is you get the tax savings as a self-employed individual. So that's where the tax savings come in, and I'm going to explain why. So let's say that you generated $200,000 in revenue for the entire year, and you decide to pay yourself $100,000. The corporation is going to be responsible for deducting your payroll taxes out of that $100,000 that you have made or that you have paid yourself throughout the year. Now, let's say that you wanted to take out an extra $10,000 in distributions. The only self-employment taxes you would have to pay on is that $10,000 distribution. That is where the tax savings come in at. Now, the disadvantages of an S corporation is there are strict requirements, just like there are with a corporation, with a C corporation. So you still have to keep up with the bylaws, the minutes, and the board meetings and all that other paperwork. And the last disadvantage of that is there are restrictions on the number of shareholders that you can have within the corporation. So you can only have up to 100 shareholders in your corporation. So just to do a quick recap. So the 4 legal structures that we talked about were the sole proprietor. The second structure is the partnership. The third legal structure is a limited liability company. Now, the fourth business structure is a corporation, where you can be registered as a C-corp or an S-corp. So if you found value in this video and you have additional questions or you want to learn more, drop your comments down below. And if you want to work with me one-on-one personally, or you want to speak with me directly, then click that link below and book a call with me. And I look forward to hearing from you and being able to work with your business and to help you achieve your goals. And until then, I will see you on the next video.